So this is me trying to make sense of economics, basically how the Fed interest rates, the inflation of the economy, and the bond values correlate because those three parameters seem to be the ones that get quoted by economists a lot. So that's what I'm going to focus on, and I'm going to try to understand as best as I can how these three parameters are interrelated with each other and what that translates to in economist lingo. So when they say hawkish or dovish, or when they say bullish or bearish, which is a fairly straightforward thing, but the hawkish and dovish seems to be something which is new, and I'm not very clear on that. And the feedback effects, like, so if you have a hawkish policy and then if the inflation is going up, how does that compare to a hawkish policy when the inflation is going down? And what happens when the inflation, the predicted inflation is that is being used to set the policy in the future? So you expect, like a hawkish person would expect the inflation to go down, go up, and 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 then they turn hawkish in order to bring that down to their level. So it's basically like everyone has a baseline value for what a good economy should be, or what a good growth rate for an economy should be, and then they are acting on it. So I want to like draw the charts and see and map out all the different scenarios and map it to the actual lingo that the economists are using. So this is going to be a first attempt. It's going to be rough, and I'm going to like fine tune it later. And as I understand more about all the different components of the system. So the first thing is, first let me just draw all the different charts. So you have, the first one is, you have your standard inflation. So let's assume a flat inflation. So this is the inflation. Then you have the Fed rates. This is all like dummy values. So this is the Fed rates. And then you have the final one, which is your bond values. Or bond yields, sorry. And so these are the three different parameters that economists look at. So what happens when? So here's the thing. So the thing that needs to be that forms the backbone for this entire analysis or investigation is that when you have an economy that's like this, and it's this wild thing, and this is your inflation rate. This could be your bond rate. This could be either inflation or the bond rate, or the bond yields. And so here it is. And what happens is they use this chart to drive this. And then this comes back and drives the dotted portion all the way over here. So that's how the feedback loop, this is the feedback loop. This is the main feedback loop that exists. So this is the main feedback loop that exists. They look at the present value, and then depending on the personality of whoever is controlling the rates, which is basically hawkish or dovish, that person then uses his own metric, his own judgment to determine what the thing is. So basically, inflation lowering. So this is what lowering Fed rates, and this could also be interest rates. This is what lowering interest rates looks like. It's basically a pipe, and you make it bigger. And so you increase money supply. And then raising is the opposite of it. So you decrease the money supply, and this actually, when this goes up, well, there is more money for long-term use. Oops. More money for risky behavior. Or investments. And this means more investment in foreign currency. And more investment in foreign currency and bonds and stocks and equity. So what happens is bond yields go down. So this specifically means bond yields go down because bond yields are measured as this is the cap and this is the current value. This is the current value. And so more money would increase this. And so the difference is the yield that drops. And so this is how it works. So lowering the Fed rates causes these effects. 1, 2, 3, 4. So these are the different effects that happen. So foreign currency goes up, the value of foreign currency goes up, and the value of bond yields go down. And this is a long-term, it increases money in the long term. And raising the Fed rates actually does the opposite of it, and you have more speculative investments. So you have more speculative investing, which is basically your equity. And so the stock market would have the index funds, which I'm guessing that this would mean index funds do that. So this is my analysis. So this is what I think is going to how the system works. So you lower the Fed rates, and this lowering of Fed rates is hawkish. Oh, I'm sorry. Lowering the Fed rates is actually dovish. So I got that wrong. This is dovish. So, and hawkish is the exact opposite of it. So when a person sees this chart, and then the Fed then comes in and says, you know what, if it's from this point on, from this point X, what is going to be the future? Is it going to be up or is it going to be down? That determines, where, along with, what is their baseline. So what they think should be the, what they think should be the value. So if they have a natural rate, it's like this. This is their eigen or intrinsic inflation, eigeninflation. And the public themselves have a different, consensus value. So let me just put the consensus in a different color. So the consensus. So this is the public. So this is the public side inflation. So all these parameters determine what is hawkish or what is dovish. So that's the hard part here, and it's very relative. So hawkish or dovish. So this is determining all the different, what you choose as the base for comparison ends up determining whether a policy is hawkish or dovish. And based on that, these parameters are now going to start moving up and down. And so I'm going to stop here, and I'm going to like pick it back up later when I have fleshed it a bit more. But I think this is a good starting point.